Hi, James.
Thanks very much for doing this. It is interesting. We don't talk to enough debt funds, I think, and it's a big chunk of the market. I think for a long time, probably people have just dismissed debt funds because it was all going the wrong way. But I think now there's an opportunity, and it's quite timely that we get to talk to you and find out more about what Invesco Bond Income Plus is doing. So as usual, do you want to sort of start off with tell us a little bit about the fund and how you're going about running it, please?
Sure. Yeah, well, thank you very much for having me on the show. Yes, so Invesco Bond Income Plus, or BIPS, which is the stock market ticker. It is an income-focused investment trust, so it invests predominantly in the high-yield bond market. My background is as a credit analyst. That's the bond equivalent of an equity analyst, and my focus has always been on the high-yield bond market. For some time now, high-yield bonds haven't really been offering high yields, but today it's a totally different story, and there's certainly a lot of high-yielding bonds out there. So for me, it's a very exciting time to be able to talk about the high-yield bond market and BIPS. BIPS itself is a £320 million investment trust. It's where I get to invest in high-yield bonds, but really I can make full use of the investment trust structure, which I think is very well suited to the high bond market. The dividend yield today, if I start there, is around 7% based on today's share price. The trust is actually earning more than that, but that is based on paying an 11.5p dividend. That dividend was recently announced by the board as an increase, actually. And you should think of that as that's based on what we believe the current portfolio can achieve over the next 2 to 3 years. And the board of the trust are very keen that we don't increase the dividend and then cut it again in a year's time. And the idea has always been for BIPS and the 2 predecessor trusts, which were merged to create BIPS last year. It's always been about a very clear message to shareholders in terms of what to expect for dividends. So it used to be 11p, now it's 11.5p, and obviously with that people can very easily figure out what dividend yield they can earn based on today's share price. So currently paying 7%. As I say, BIPS is earning quite a lot more than that, and of course that extra income will be kept in the trust and reinvested, and obviously you'll see that in the net asset value. Another reason I'm really excited about our markets at the moment and BIPS is the potential for capital gains in bond markets from this point, in addition to a good level of income. And that's really very simply because bonds are a contractual obligation from a company or a government, but we focus on bonds issued by companies. So they must be repaid at a price of 100. At maturity. That's the typical repayment price for a bond for the vast majority. That's a contractual obligation, and with an average price in the portfolio today of around 86, because we have had this savage repricing of bond markets this year, and excuse me, an average maturity of around 5 years, you can add what we call the pull to par, so that capital increase as bonds go back from average price of 86 today to 100 over the 5 years. You can add that pull to par, that yield to the income, and you get a pretty attractive all-in yield today. Specifically for BIPS, the fund's current gross redemption yield is around 9.6%. I don't know how familiar listeners are with bonds, but I mean, gross redemption yield can be a complicated sounding term if you're not a bond person. But essentially, the gross redemption yield is simply the all-in yield. So it's adding up the interest part plus the capital appreciation part, if it's there, which it certainly is right now, as a bond pulls back to par over time. So as I say, that's around 9.6% today on the portfolio. And then the final part of the puzzle to get excited about for BIPS specifically, so I manage 3 funds, but BIPS is the investment trust that I manage. Because it's an investment trust, it's a closed-ended fund, obviously. I can use gearing or borrowing. It has to be done carefully, of course. and today we're at around 20% of the net asset value. So yeah, I'm sure everyone appreciates how this works, but that increases the size of the portfolio by 20%. And of course, that means it amplifies the 9.6% yield on the portfolio by another 20%. So gets us to well over a double-digit return profile. It's a nice time for me to be able to talk about the high bond market and BIPs because there is so much more yield available today. Having said that, I can't just, I shouldn't just sit here and wax lyrical and ignore the challenges that lie ahead over the next year or so. There are a lot of macro issues to worry about. Everyone's aware of that. We have a cost of living crisis, mortgage rates have shot up, an ongoing energy crisis, inflation is still high, none of which are good for consumers and for economic growth. And certainly for high yield bonds, that is something we still need to worry about over the next several quarters. But we can manage the fund with that in mind. Some of the mitigants we use, we keep a very diversified portfolio. So we have bonds from over 180 different companies within the trust. We've got a team of very experienced credit analysts. That was my background before becoming a fund manager. And our job as a team will be to navigate the portfolio through a more challenging economic environment going forward. And really the good news today is that we can get a very good income right now without having to venture into the riskiest parts of the higher bond market. And if your listeners are familiar with the rating agencies, I'm broadly speaking about the CCC rated part of the higher bond market. That is the part of the market that I'm most worried about for next year, just broadly speaking. And maybe to kind of just give an example, give a really good example actually of a recent purchase of a bond from a company that people will be familiar with, but it does sit in the very low credit risk category. So it will still pay BIPs a handsome return over the next 10 years. Oh, thanks, James. It's not actually on in the presentation, but I will talk about these bonds on the slide now. But Centrica bonds. So 3 or 4 weeks ago, during the pension fund turmoil, the LDI turmoil in the UK, able to buy Centrica bonds with a coupon of 7%. So these are investment grade rated bonds. They were issued way back in September 2008. So during the financial crisis, when the market really demanded a high level of coupon of 7% for a company like this. Obviously, over the next decade, with yields falling to the levels that they fell to, the price on that bond increased dramatically to about 160. That meant that the yield was down at around 1.5%. And then a few weeks ago, obviously this has been a bad year for bonds, so these bonds are traded down. Then we had some forced selling, and we were most likely buying these bonds from a forced seller in that market, picking those bonds up at a price of 100. So having gone from 160 in 2021 to 100, and with 10 years left to maturity, paying 7% interest each year, that's not even a high yield bond, it's an investment grade rated bond. And I can buy that for BIPs and feel very comfortable that it will pay our shareholders that contracted, and again, that's very important. It's very different to a dividend, that contracted 7% every year for the next decade. And that example is before I've even ventured into the world of high yield bonds, where you have to think more about the credit risks of the companies whose bonds you're buying. So yeah, I think there's a lot of challenges ahead still for economies, but for income investors today, there's the potential to put together a really nice portfolio that is built to weather those challenges.
Cool. Okay. So actually, I pulled this slide up a bit too early, maybe. But this is an example of what you're saying, really, about the pricing. Yeah.
It is. Yeah. I mean, we've put 3 examples on here that I've been talking about recently. All bonds that we purchased very recently. So let me talk through them. So on the left-hand side, these we call them primary issues, primary purchases. So as in new bonds that were issued into the market. The top left is Verisure. So Verisure is a Swiss alarm and security company, issued a bond in October with a 5-year maturity to October 27, and had to pay a coupon of 9.25%. The second bond there, we've called it the called bond. So this is what they were refinancing. That only had a coupon of 3.5%. In 2021, they'd come to the market and they'd issued a bond with a coupon of only 3.25%. For 6 years maturity. So you can see, to go from issuing a bond at 3.25% in 21 to in October of this year, having with the company looking not dramatically different, but the market being dramatically different, and the market demanding 9.25% compensation. And that, for us, that's a really attractive prospect, because if a company can afford to pay that much higher level of interest on its debt, then great. We can buy that, we can put it into the portfolios, and we can feel very comfortable. And really, all that's happening there is we're seeing creditors, so bond investors, we're creditors, we're lenders to these companies. We are suddenly getting the benefit, the value out of these companies, rather than previously shareholders. And in this case, it's a private equity. So it's great to see that kind of shift from the equity side to the creditor side. And this year we've seen very limited new issuance, as you would expect. This is very typical when the market is volatile and weak. Very limited new issuance, but when we have seen new issuance, the coupons that are being issued at are dramatically different. The second example there is Deutsche Bank. They issued a bond with an even higher coupon of 10%. And again, really good news to be getting income like that into the trust. And certainly Deutsche Bank has had issues over the past few years, but the bank has taken a lot of positive steps since then. So on the primary side, and this is a 23-24 story, as companies come to issue bonds going forward, we expect them to be paying much higher coupons. And that's going to be really good news for bond investors looking for income. At the same time, we're not just waiting for that to happen. We've seen very limited new bonds being issued this year. In the secondary market, there's some really interesting opportunities right now. So I've included on the right-hand side of this slide a bond from Asda. This is their senior secured bond. So they also have junior bonds. It was issued in 2021 during a very strong time in the market, and so the market at the time said, "Fine, we'll lend to you at 4.5% coupon for 5 years." Subsequently, we've been through this huge repricing to high yields across the board, and so the price of that bond fell from its issue price of 100 to the price that we bought some that I've included here of 77.75, so call it 78. So fallen 22 points, meaning by the time we get back to 2026, provided Asda hasn't gone bust, and we don't think that it will, Asda will have to pay us back 100 in February 2026, and that's 22 points of upside from where we bought them. In the interim, we'll also be earning over those 3.5 years the 4.5% coupon. So that's 4.5 points times by 3.5 to give you another 15.75 points of coupon. Add that with the capital gain, as we have that pull to par, and you're looking at a close to 50% total return profile for that bond over the next 3.5 years. And actually, I'd also expect to get to that point earlier than 3.5 years, because companies will typically refinance a bond about a year earlier than the actual maturity. So provided we've done the credit work, provided we understand the risks with ASDA, then that's a fantastic looking return profile for us to be investing in, and actually stacks up pretty well against what you can get from equities. The key difference being it's contractually obligated. Anything? Yeah, yes, please.
Do you ever buy floating rate debt, or is all of this fixed interest?
The majority of this portfolio is fixed rate. We don't invest in leverage loans. So leverage loans are typically floating rate, are always floating rate. There are floating rate bonds out there. They're a relatively small part of our market, and they don't often behave in the way that you would hope they would. I mean, they do. You are able to strip out the interest rate sensitivity element. That's great, but they don't just sit there at a price of par. There's still the credit risk component, which has to be priced. And so a lot of floating rate notes over the years have been priced to the advantage of the issuer. So they're getting, because people, investors are concerned about the potential, were concerned about the potential for rising rates. The issuer said, okay, but we'll pay you slightly less on the overall coupon at the start. So they haven't necessarily stacked up well against their a fixed rate bond equivalent. And then, as I say, the credit risk still matters, and has been repriced. So a lot of floating rate notes are still trading below par. I mean, there are other tools that we can use if we're worried about rate sensitivity, and that is what we did at the start of this year. So keeping the rate sensitivity on the portfolio low, which is what we had at the start of this year. That means focusing our holdings on shorter dated bonds that have less duration, avoiding bonds that a lot of bonds that have been issued over the past several years with very low coupons, and the factors that go into rate sensitivity for a bond is not just the time to maturity, it's also the coupon. So a low coupon adds to that rate sensitivity as well. So for us, we haven't been particularly enamored with the levels of yield that have been on offer in the market for several years, and certainly at the end of last year, after a very strong rally coming out of February, March 2020, at the end of last year, we felt that yields were generally quite low, and so the portfolio reflected that. We had liquidity, we had a shorter duration, which means less rate sensitivity, and a more cautious profile in terms of credit quality. Obviously, there is gearing on the portfolio, so when the market falls, that gearing amplifies the impact of market falls. But I'm actually quite pleased that, given that gearing, we've managed to for most of the year be ahead of the index in Europe, and just very recently have moved to kind of very equal in terms of performance. Obviously, what you do have now is we've got a portfolio that has got the gearing in it, and that gearing will help us on the upsides. And going back to that point about pull to par.
Sure. This slide answers one of the questions here about how many holdings you've got.